rolling options. So many traders do this. I never do. Here's why. Stay till the end. Check out my whole video. I'm going to explain exactly what traders are talking about when they roll options and why there is definitely a better way. So first of all, many traders talk about rolling options in the case of selling a covered call, right? And let me explain to you what that means. So again, when you sell a covered call, I'm going to give you an example. I own 100 shares of ABC stock and I paid $100 per share. And then I sell a $105 call against that stock. I take in premium, I get paid money, right? That goes into my account right away. And I'm committing to sell my shares if the shares go above 105 by the expiration date. So that's good because of a couple things. Number one, I paid $100 for the shares, so I'm agreeing to sell them at 105. So I'm making money on the shares, of course. And number two, most importantly, I'm taking in guaranteed income. See, when you sell a covered call, guys, you're taking in money and you get to keep that no matter what happens. It's guaranteed cash flow. I've said this in other videos. I would much rather have like a guaranteed $100 today than a maybe $102 next month or maybe $105 next year. Wouldn't you? So when traders talk about rolling a covered call, here's what they mean. In my example, if I sold my $105 call, and let's say that particular stock starts to shoot up, right? Let's say it goes up to $150. Well, guess what? I've already committed to sell my shares at 105. So sometimes traders will have remorse when that happens, and they will think, oh my gosh, what did I do? I should never have sold that call. I should have waited because I would have made more money. And what they do is they buy their call back and take a loss. You see, if the stock goes up, the call becomes more expensive. So when they buy their call back and roll it, what they're talking about is rolling and selling a new call for, let's say, next week or a different strike price or something like that. They are now gambling that the stock is going to continue to go up. However, they're locking in their loss on that contract. Here's why that is really not advisable and why I never do that. I don't trade to lock in losses. I trade to lock in gains each and every single week. Like, you need income in order to sustain your lifestyle. So the name of the game, people, is locking in realized gains, hitting a single, hitting a single, hitting a single, and winning the game. It's not about locking in losses and betting that the stock is going to go higher. No, you have to be grateful for taking in the premium for having sold your call. You sell your shares and you make money on the shares, and then you do another trade next week. See, here's the thing, guys. We don't know where the market's going to go. We don't know where the stock's going to go. Maybe it goes up, maybe it goes down, maybe it stays sideways. So the name of the game is to trade and make money regardless of where the market goes. I'm not a fortune teller and I want to create income every single week. I don't want to be subjected to market volatility. That's why it is so inadvisable, in my view, to roll a covered call in that scenario. Now, let me give you the second scenario when traders refer to rolling a short put. So let's talk about a short put for a moment. A short put is like when you sell a put, what you're doing is you're collecting income. Remember, you keep that income, you get paid right away. And for that income, you are committing to purchase shares of that stock if it drops below the strike price before the expiration date. So I'll give you an example. Let's say I like ABC stock and it's trading at $100. Well, I sell a put with a strike price of 90 that expires on Friday. What I'm doing is I'm committing to buy 100 shares of that ABC stock, but only if it goes below $90. And then the price that I pay is $90, which is the strike price. So when you sell a put, you first of all, you sell it on a stock that you're super comfortable in purchasing, and you're choosing the strike price. So you're thinking ahead of time, okay, how much am I comfortable paying for that particular stock, right? So when people talk about rolling a put as an example, here's a scenario. Let's say ABC stock goes down to like, $70 per share. Well, the trader that sold that $90 put is thinking, oh my gosh, I really don't want to buy that. Let me just roll that contract out. And what they're doing is they're buying back their contract and then they're selling a new one further out, maybe another week, maybe another month, maybe a different strike price, a little bit lower, that sort of thing. However, just like in the case of when they roll a covered call, they are actually locking in a loss. Because here's what happens, guys. When the price of that stock goes down, the price of that put contract goes up exponentially. So they're going to pay more, much more oftentimes, to buy that contract back. And then they're just gambling and guessing on the direction of the stock. Again, we don't trade because we want to predict the price movement of a stock. No, we want to create income each and every single week, regardless of whether the stock goes up, the stock goes down, the stock stays sideways. And the purpose of selling options is to create realized gains from week to week. Realized gains from week to week is really cash that you put in your pocket that you can spend any way you want, and that can sustain your lifestyle. So that is exactly why I never roll contracts. In the case of my covered call that I spoke about a moment ago, I'm happy to have my shares called away. I'm never sad because I could have or should have made more money. No, I'm happy that I did make the money I made and I put it in my pocket, and next week there's another trade. In the case of rolling the short put that I explained a moment ago, I'm also never going to lock in my loss. I already thought, okay, I'm going to sell a $90 put on ABC stock because I like ABC stock. So I'm already prepared to buy that stock if it goes down. And guess what, guys? If the stock goes down and I have to buy those shares, I'm going to sell a covered call against it. And in my scenario, if ABC stock goes down to like $70, let's say it goes down a lot, I'm going to maybe sell another put or I'm going to buy more shares at a lower price. Why? Because if I like ABC stock at $100 or I like it at $90, I like it a lot at $70. Warren Buffett says, you know, when the market's going up, everybody makes money. But really, when the market goes down, if you have extra capital to infuse into the market and buy more shares as it goes lower, that's a game changer. That's when you make exponential money. Anyway, I hope this helps. This is why I never roll my contracts. If you like the video, subscribe to my channel. I'm putting up videos each and every day. I talk about trading tips, different motivation type videos. If you want to know more and you want to join one of my live events, subscribe to my inner circle. That way you'll get on the list. Every time I announce new live events, you'll be one of the first people to know. Cheers for now.